Hey traders, this is Blake Morrow with Traders Summit. And I mean, you have to wonder, is Jim really going to be right? Jim Welsh of Macro Tides saying that the market is going to trade to all-time highs. Well, stick around and you're going to find out because I'm going to bring Mr. Jim Welsh from Macro Tides in today. Jim, how are you doing?
I'm doing fine. It's Friday. Hopefully, it's the downward slope of a week, and I'm sure you're ready for a weekend as well. So here we are.
I am, and I have to say we're getting dangerously close to all-time highs. And I know you've been saying, hey, there's a chance we can complete wave 5 at new all-time highs. And
Yep.
I'm anxious to see the charts that you have that are going to tell us if we can or can't. But before we get into that,
Yeah.
let's talk a little bit about this week's price action. I mean, CPI got a lot of attention. Producer prices did as well. Inflation seemed to come in high. And I didn't look at your slide deck to see if you're talking much about inflation. But what was your take just off the cuff about the market reaction this week and the stickier inflation that we saw?
Yeah. The market kind of got a 1-2 punch on overnight on Tuesday and then Wednesday morning when the CPI first was the debate. And, the consensus was that VP Harris had done better. It certainly looked that way to me. And the S&P's futures sold off, because she's got proposals to raise corporate taxes and a bunch of other things. And then the CPI, the core came in a little hotter than expected. But I think what turned the tide on Wednesday morning more than anything else was the CEO of NVIDIA was being interviewed at a Goldman Sachs conference. And he talked about how, gee, for every dollar somebody spends on artificial intelligence, they're going to generate $5 worth of revenue. And that caused a very quick and sharp reversal in NVIDIA. That's kind of been the focal stock for quite a while. And as NVIDIA rebounded, I think it was up 3 or 4% by the end of the day on Wednesday. It pulled other semiconductors, technology, and it was kind of like, okay, the S&P rebounded very strongly. Yesterday, we saw the Russell rebound. It's following through today. So the key actually to the week wasn't so much the PPI or CPI. It was NVIDIA reigniting the hopes and dreams that AI is going to be the panacea that solves all of our problems.
Well, maybe it will be. I mean, but you talk about a 1-2 punch, and it was one, and I know you're going to actually talk about the yen. And I'm trying to think of the yen, the Japanese official. Now it starts with an
I
N.
can't pronounce their names, but there were two of them actually that talked this week
Yeah.
and talked about, hey, we're going to be raising rates.
Yeah, and that was kind of like that was
happening.
That was happening during the debate, and so a lot of people looked at Bitcoin dropping, the dollar yen falling, but weren't necessarily looking at the headlines. But anyway, there's kind of a lot of things that were working against the market at that moment. But then,
yes,
as you pointed out, everything turned. But I want to get into the charts because you brought a lot today, and I was going through your charts as I was uploading it. I'm like, man, he's got a lot to say today. So let's just jump into it, Jim, and jump into your first one about recession odds. I mean, you've been talking about possibility of a recession, and I don't know, Jim. I'm almost not a non-believer. Almost a non-believer that we're just going to get this no landing. I mean,
it's going to happen, right? Yeah.
What does this chart here tell you?
Well, basically, what it shows is how different asset classes have been trading. And treasuries and base metals have been trading off of the idea that the economy is going to slow materially. And in terms of base metals, not just in the US, but globally. And so the recession odds for those two asset classes is north of 60%. Then you look at the S&P and then high grade corporate bonds, high yield corporate bonds, and they're like 5%. So the Russell 2000 looks like about 15%, and then cyclicals versus defensives looks like about 25%. But my point is the bifurcation in markets in terms of how treasuries have been trading relative to stocks. Now, part of that is, I think, that the economy slowed, inflation's come down, the prospect of rate cuts are here. So I would kind of add a layer to this chart and saying, yeah, these are kind of responding to the potential of an economic slowdown. But in terms of treasuries, they're certainly responding also to the prospect that the Fed's going to be lowering rates. The only issue is how frequently and by how much. So I just thought this was kind of an interesting counterpoint to, people want to believe that markets discount the future. I mean, they say it on TV all the time.
They do. They do.
Here we have markets obviously responding to exactly the same stimulus, but very differently.
Right.
It's just sometimes, I think, worthwhile to kind of look at, I don't want to say oddball, but different perspectives. And this is one that, to me, just provides some contradictory. Again, we got to go back to the government is spending so much money. The deficit is almost 7% of GDP. GDP is growing at 2.5%. So one of the props that has been, if you will, slowing the onset of more slowing in the economy is government spending, not just on the federal level, but also on the state level. So, again, the progression of weakness in the labor market that we talked about last week is unmistakable. It's just taking longer to unfold. And that's why, I've held on to the idea that the economy is going to slow a recession. At the same time, technical analysis has helped me be able to identify the trend in the market. And as you noted earlier, the expectation is we're going to a new high. And so, to me, it underscores the value and importance of combining technical analysis, or at least including it along with economic analysis.
Sure does. All right. Well, the next chart you brought is CPI, and I guess this is to help break down what had happened this week.
In Monday's report, I thought we'd see the core or the headline drop to 2.6. Rounding got it to 2.5. The core was, as I noted earlier, came in a little higher. We're talking basis points, so it was flat at 3.2. But the trend is unmistakable, and the key thing is what we've heard in recent months from the Fed, starting at the June meeting, was we need to have more confidence, particularly as expressed by the hawks on the FOMC. And that was, reiterated in the July meeting. And so I think months having passed, we're seeing modest progress, but it's progress. I think the confidence level has increased, which is why, as we discussed at the July meeting, the hawks weren't quite ready to cut rates at the July meeting, but they're going to agree to a cut next week. It's just now the open question is the magnitude.
And what do you think?
Well, let's look at the next chart. What do you know? Wow, this is kind of almost organized. All right, so this shows the June summary of economic projections. That's the SAP. And what you can see when you look all the way down to the bottom, at the end of 2024, the median of the 19 people who cast a vote, if you will, or expressed an opinion regarding the Fed funds was 5.1. That implied one cut. So we have 3 meetings left, including next week. And the question is going to be, where will the median come in for 2024 as well as 2025? To me, this is going to be the preeminent issue. So is it going to be 2 cuts, which would get you down to the 485-ish range, or is it going to be 2.5 cuts? And so to me, that's a tough call, whether it's 2.5. The one thing I think the dots won't agree to is Wall Street's expecting effectively like 116 basis points of cuts, which is obviously more than 4 quarter point. So now Wall Street's looking for not 1, but 2 50 basis point cut in the next 3 meetings. So I think at best the median will go to 475, and I think there's an equal chance that it could be 487. To the extent that everybody really is looking for the Fed to be more aggressive, that could be a disappointment. The other issue, again, trying to go inside that FOMC meeting, Blake, the discussion and debate between the Hawks and the Doves. The Doves are going to be for cuts every single meeting, without a doubt. The Hawks, as we saw in July, are a little bit more measured in terms of how they want to approach this. So to me, I think what could also be a disappointment is the ending of where the funds rate will be at the end of next year. I mean, that's like forever, in terms of market time and everything else. But I think the Hawks are going to be more, as I said, measured. That until we get more data, they very well might be comfortable with saying every other meeting. So, what that would imply is about 150 basis points, maybe 175 by the end of next year. I think, again, they're in the camp of, okay, it's time to cut rates. We should do that. I want to have more data, even more confidence to get more aggressive. So that's what it's going to come down to. And unfortunately, you and I aren't going to be able to have a conversation next Friday, which is really too bad, because I think it would have been very interesting.
Well,
so we'll have to do it the following Friday.
Jim, based on the comments that you just gave us, and I know we need to move along. We've got other things we need to talk about, and you're going to reference the dollar. It sounds like to me it's not going to be a too dovish of a meeting, and the dollar might have a snapback rally. I'm sensing that from you. Yeah.
Well, when we get to the dollar chart, you'll see that that's exactly the take that the chart to me seems to be implying. So again, we like this morning on CNBC, the idea of 50 basis points is rampant. Why? Because Bill Dudley, who was the president of the New York Fed for many years, came out and said they should go 50. Well, he also wrote an article before the July meeting. They should cut this meeting. All right. Now, in 2016 or whatever, or was it 2020? I can't remember. He's strongly in favor of Democrats. So, he wanted to cut in July because he wanted to make sure everything looked good in November. So, he's not part of the Fed, so he has obviously the right to express his political views along with his projections. But anyway, he's influential, so that's gotten a lot of people on that maybe they're going to do 50 bandwagon.
All right. Well, before we get into the dollar, you wanted to talk about the yen. So let's go into the yen. And this has been obviously pushing us towards 140, the big figure in the dollar yen.
Yeah. So back on August 16th, right after a lot of stuff happened, we looked at the yen chart, and my take was that we were having a pullback that was likely wave 4, and that it would be followed by a rally above the wave 3 high at 71.87. And the targets were, as I noted then, 72.40, 73.50. Looking at the chart and the way it's unfolded, Blake, I think there's a real chance that if you look off to the left, last December, late December, it got up towards 75. So I think, again, the idea was it's going to go to a higher high. As you noted earlier, some of the Bank of Japan people, kind of supported, no, we're going to be raising rates, and that has really helped over the last week give the yen a tailwind. So again, I just wanted to review because, the yen, when we had that conversation on August 16th, had reversed really hard and dropped pretty sharply. And again, the pattern implied that huge thrust into wave 3 implied that, okay, it's likely to go higher. That, in other words, the yen carry trade wasn't completely unwound. And that, coupled with, Bank of Japan comments, has enabled it to make a higher high.
Okay, great. So now you're talking about crude, and
Yeah.
crude's obviously seen a hella move. And I've been a big advocate about like not being bullish because I put it this way, I thought everybody was bullish, and going into the last several months, because why wouldn't you be, as a hedge? But I think that explains why crude sold off. But tell us what we're seeing here.
Okay, this is just a positioning chart, and it shows how at different turning points it gets to an extreme. The mid range is kind of like noise, can't read into it, but this is a very, very low number, which again suggests to me that we're in the zip code of a price low. And as you said, going back not that long ago in 2024, you can see that the positioning was far more bullish, in terms of people expecting higher prices.
Sure.
So when you see these kinds of extremes, it's like, okay, now it's time to start thinking about doing the contrary opinion, because what's driven this big decline is the idea economy slowing down, demand's going down, OPEC is out of control, they can't really blah, 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 blah. So this tells, I think, that, okay, it's time to pay more attention to crude in looking for a price low. In the next chart, we're going to look at it very quickly.
I'm getting to it. Just give me 1 second. There it is.
Bada bing, bada boom. Okay, so this is a multi-year chart, and you can see as it gets to mid 60s, it's been a significant turning point in terms of crude bottoming. And so, okay, on one hand, we've got positioning showing a lot of people have gotten really negative. Now they're looking for much lower prices, just as crude is getting down to important support. This is a weekly chart. The red and green lines are the 5-week and the 13-week moving average. I didn't want to add another chart, but I'll follow up in coming weeks in terms of waiting to see price confirm the idea that the positioning has gotten extreme and support is holding. That said, the positioning got pretty extreme back in last year at 1.2, and you can see for about 5-6 months, oil just sort of chopped with a downward bias. So, given that the outlook is that the economy, I think, is going to show more signs of slowing, that this a basing period for oil in the mid, between 65 and 70 is going to be possible before we really see a reversal. But I just wanted to point out as a counterpoint where the positioning was in oil, and let's look at it in terms of positioning in gold. So in terms of trying to identify intermediate bottoms and sometimes major bottoms in markets, positioning can be pretty helpful. And this shows that the pink lines are positioning. So what we can see is more people are bullish and positioned for higher prices relative to going back to 2021. As you can see, in 2019, positioning got pretty extreme, which is, again, positioning tells you the zip code. You need to use price momentum to identify the actual turns. They have to go hand in hand. And of course, the outbreak of the pandemic made a big difference, from what gold did at the beginning or late 2019 into, the spike high in mid 2020. So again, my only point is, all right, people are getting pretty ramped up. Gold's making new highs, baby. Rock and roll. All right, let's be a little more sober about this. Let's look at the gold chart. And what we can see,
I'm getting into it right now. Sorry, I'm just deleting.
It's Friday. It's been a long week, and Blake is just a little tired.
I am just slow. There we go. All right.
All right. So for weeks, the comment has been gold has to hold above 2470. The last trading low last week was 2474. The week or a week or so before that was 2474. And here we are. We're breaking out to new highs. I think, in my view, that what's happening here is we're completing wave 5 from the low of 1812 last September. So in other words, we're nearing the end of the move up, Blake. And it's like, okay, now the positioning is saying caution is warranted. The pattern is saying caution is warranted. What we need to see is price reverse, and at some point in time, the 5-day exponential, the red line, will cross below the green exponential, and that'll be more of a confirmation. I think once a top is in, gold has the potential of declining back down towards 2,300, 2,350. I think after that, there's going to be another move up, but I just think near term, the positioning, the pattern all suggest that this is a time to probably do some selling in gold as we get close to 2,600.
You know, some of the very basic technical analysis work that I've done, Jim, suggests 2,600 because it's just the range extension from 2470 to 2530 takes us to basically just shy of 2,600. So maybe that's the upside target, is just, you know.
Yeah, I mean, and with gold, as you know, I mean, it could go 1%. You know, could it get to 2620? Of course. My only point is, instead of getting caught up in the hoopla, what this stuff suggests, it's time to, like, okay, they want it that bad, let them have some. You know,
Yeah.
I don't think the major trend is topping out or anything like that. I just think that this is a time to become a little bit more cautious, which means if you got a position in gold, you lighten it up by 25% to 1/3, and then look to buy back if indeed a pullback develops.
All right. Well, you know, scary because you have been pretty bearish the dollar.
Yes.
The dollar has broken down out of the triangle that's illustrated here. And you've been right. I second guessed you, and the dollar did break down, but it sounds like you're a little bit more constructive, because if you're bearish gold, that means you're probably constructive the dollar. You talked about the FOMC. They might be a little bit more hawkish than the market expects. Could the dollar rally from here?
A little bit. I mean, what the pattern suggests, Blake, is, you know, that red number 3, well, going back to the 105.52, you see 1 down, 2 up, 3. And so last week is, okay, we're in wave 4. I thought it might get up towards the 102 to 102.50, you know, in the last 2 weeks. It got up to 101.92, sold off, rebounded. The secondary high was 101.84, I believe. So there's the potential that a triangle's happening. A, B, C, we're in wave D. As long as it holds above 100.58, a bounce back up towards the 101.50 to 101.80 for wave E, and then a drop. Either way, I think the dollar is going to drop below the low we saw for wave 3 at 100.5 something, whatever that is. And then once that's completed, there could be a larger rebound that takes the dollar back up to wave 4 of lesser degree. Longer term, we've talked about this for a number of weeks. I think the pattern implies the dollar's headed toward 95 and below. And so now we're just trying to, you know, navigate the twists and turns. In terms of how we get there.
Okay. All right. Well, so one market that's been absolutely on fire has been, well, you're looking at, the 30-year.
Yeah.
You're looking at the yields. They've been getting crushed. TLT's been rallying. The bond's been rallying as you expected. So what do you see here now?
Well, I talked about an intermarket divergence last week, where the 10-year had dropped below the low of December, but the 30-year hadn't. And what you can see now is this week, the 30-year dropped below December's low. All right. So, okay, remove that negative out of the equation. The other negative was RSI diverging. So despite yields coming down even more, the RSI is hitting a higher low. Now, when yields bottomed last December, the same thing kind of happened, where prices went to, the yields came down to a lower low, but the RSI made a higher low. The divergence this time is even larger. So that just suggests to me that a give back window of time is approaching for treasury yields to tick higher. If, again, the Fed doesn't deliver the goods next Wednesday in terms of the summary of economic projections and what the funds rate, you know, what they're kind of going to convey, Can bonds sell off, yields tick up? Yes. So to me, all that said, you can see the 5-day exponential is red, the 13 is green. It's still positive. All right. So we haven't seen a price reversal yet. I think the warning signs in terms of the RSI divergence are there. TLT, back in April, I was recommending in anticipation that yields would come down. I've instructed, basically subscribers, okay, sell a third of it above 99.93, which happened over the last week. And, whether I sell some more, I'll kind of make that decision on Monday. But ultimately, I still think TLT is going to 105, 109. Again, predicated on the idea that the economy is ultimately going to show more signs of slowing. And if indeed a recession appears next year, TLT could see a rally to 119.
All right.
Right now I'm just trying to navigate where we are and what's in front of us.
Well, the last chart, Jim, you brought is what is going to happen with stocks. Again, you've been calling for all-time highs, and that being wave 5.
Yep.
Is that still possible?
Yeah. As long as S&P on this pullback that we saw into earlier this week didn't trade below 53.30. Why? Well, because the way I was interpreting the chart, the low at 51.19 was wave 4. From the April low, pardon me. 1, 2, 3. This pullback was a little bit deeper than I thought, but it held. And what it looks like is we're in wave 5. We've had 1 of 5, 2 of 5. The last few days have been wave 3 of 5 after the bottom on Wednesday morning. And it should carry above 56.70, 57.30-ish. There's some price targets that one could, make a guess on up there. If all that unfolds, Blake, my belief is that the S&P will have a high, and then we're going to see another correction. The depth of that correction remains to be seen. The first target would be going back to wave 4 of lesser degree, which is 51.19. The next target beyond that is 49.54. If indeed all this unfolds, we go up to 5,700 or whatever the number turns out to be and begin to retrace, that'll provide some important clues of, all right, is it going to, first of all, take out 5,400 and then on its way to 51.19? But so again, like bonds, like gold, it's kind of like, okay, we get new highs. It's a good time to probably lighten up or do some hedging in anticipation of a pullback. If the economy shows more signs of slowing, and if a recession develops next year, the correction that's going to come, if and when that happens, is going to be much more severe than 49.50.
Well, Jim, I'm a big fan of
4,100 becomes very likely.
I'm a big fan of if then that, and we got a lot of that analysis over the course of the next couple of weeks. Speaking of the next couple of weeks, for those of you that enjoy what Jim does here each and every week, make sure you give him a big thumbs up. Subscribe to the channel so you don't miss any of his exclusive interviews. Make sure you email Jim at, what's the email, Jim?
Jim Welsh Macro at Gmail.
And just want to let you all know, Jim will not be with us next week. Jim will be gallivanting around the United States. So
Montana, to be specific.
Yeah, and it seems like you go there every year because we miss you for that weekend pretty much every year. So you're doing your annual trip. We will miss you next week, Jim. And especially following the Fed, I'm sure you're going to be in some sort of backward ass cabin with very little internet, trying to tweet some stuff, about what.
Fortunately, it's not a backward cabin. It's just well outside of Missoula, and internet reception is
backward ass,
but not 100% reliable.
Look, I love Montana, probably one of the most beautiful places I've ever been in the world. And so you have a wonderful trip. We will
Thanks.
miss you. And let Jim know down below if you're going to miss him next week. Jim, I want to thank you so much for everything you do for our Trader Summit community. And folks, make sure you give him a thumbs up to suggest that he does that. So, Jim, have a great trip. We'll catch you in 2 weeks.
You got it, Blake. Take care.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.